NVIDIA made more money last year than Intel has made in the last 5 years combined. Their gross margin is 75%. For every dollar of revenue, 75 cents is profit, before operating costs. No major hardware company comes close, and yet the stock has gone nowhere for 6 months. We dug deep into the numbers, and what we found tells you something important about where the AI trade is heading. Here is the disconnect. NVIDIA just reported $68 billion in revenue for a single quarter, more than Netflix makes in a year. Growth was 73%. Earnings beat by 8%. They guided $78 billion next quarter, blowing past even the bulls. By every standard, this was a perfect quarter. The stock dropped 4% the next day. Most people think of NVIDIA as a chip company. That misses the point entirely. NVIDIA is an infrastructure monopoly. 90% of every AI training workload on Earth runs on their hardware. Not 60%, not 70, 90. Their closest competitor, AMD, has been growing fast, but still commands single-digit market share in AI accelerators. This is not a competitive market. This is one company and everyone else. What makes NVIDIA nearly impossible to compete with is not the hardware alone. It is CUDA. Over the past 20 years, NVIDIA built a software ecosystem that millions of developers, researchers, and companies depend on. Switching away from CUDA means rewriting years of code, retraining teams, and accepting worse performance during the transition. This is the kind of lock-in that makes enterprise software companies jealous. Now, the numbers that matter. Fiscal 2026 revenue was $216 billion. To put that in perspective, 5 years ago it was under $17 billion. That is a 13-fold increase. Net income reached $120 billion, and the company generated almost $97 billion in free cash flow. These are numbers you normally see from entire industries, not single companies. The growth trajectory is staggering. Fiscal 22, $27 billion. Fiscal 23, $27 billion again because gaming collapsed. Fiscal 24, $61 billion as AI demand exploded. Fiscal 25, $130 billion. Fiscal 26, $216 billion. Revenue doubled 3 times in 4 years. There is no precedent in the history of the semiconductor industry. Not Intel, not Qualcomm, not anyone. What drives this is data center. The segment generated $62 billion in the fourth quarter alone, up 75%. For the full year, it represented roughly 90% of total revenue. Gaming, which used to be NVIDIA's identity, is now under 8%. 5 years ago, gaming was half the business. NVIDIA did not just pivot to AI. It became an entirely different company. The margin structure tells you something most analysts gloss over. Gross margin was 75% in the fourth quarter. Operating margin exceeded 60%. For a hardware company shipping physical chips, that is extraordinary. Apple's gross margin is around 46%. Intel's is around 36%. NVIDIA operates with software-like profitability on hardware revenue. That combination is almost unheard of. But here is what concerns us. The margin direction is down. A year ago, gross margin was 76%. Now it is 75% and trending lower. Management guided next quarter at the same level. The reason is mix shift as newer Blackwell chips ramp at higher production costs. Even a small decline on $200 billion in revenue moves billions of profit. Free cash flow is the real story. $97 billion in a single year with a 45% margin. Capital expenditures were only $6 billion. Compare that to Amazon spending $200 billion. NVIDIA generates enormous cash with minimal physical investment because its customers build the data centers. NVIDIA just designs the chips. Now the product roadmap. The current Blackwell architecture is ramping aggressively, but what has the market excited is Vera Rubin, the next platform scheduled for the second half of 2026. NVIDIA claims 10 times better performance per watt. If that holds, every data center operator will need to upgrade again.
This creates a perpetual upgrade cycle that keeps revenue growing for years. One number that almost nobody talks about: NVIDIA's research and development budget is approaching $20 billion a year. That is about 9% of revenue. For context, AMD spends around $6 billion and Intel around $16 billion, but on a much larger product portfolio. NVIDIA concentrates its research spending on a narrow set of problems, specifically AI compute and networking, and outspends competitors in that specific domain. This is how they stay ahead. The China situation is a real wild card. U.S. export controls have restricted NVIDIA's ability to sell its most advanced chips to Chinese customers. China revenue has declined sharply, but reports suggest Chinese companies have placed orders for over 2 million H200 chips at $27,000 each. If those shipments are approved, that alone could represent over $50 billion. The political dimension makes this unpredictable, and it swings both ways. So is NVIDIA expensive? The trailing price-to-earnings ratio is about 38 times. That sounds high, but the forward multiple, based on fiscal 2027 consensus, is roughly 22 times. That is cheaper than Microsoft, cheaper than Apple, and cheaper than most high-growth technology companies. When a company grows earnings at 70%, 22 times forward earnings is not expensive. It is quite reasonable. Morningstar values NVIDIA at $240 per share. The stock trades around 186. That is a 23% discount to estimated fair value. They assign a wide moat with very high uncertainty. The wide moat means they believe NVIDIA's competitive advantages are durable. The very high uncertainty means the range of possible outcomes is extremely wide. Both of those assessments are accurate. Wall Street is overwhelmingly bullish. 38 analysts cover the stock with a strong buy consensus. The average price target is around $263, implying over 40% upside. The highest target is $360 from Evercore. Earnings per share estimates have been revised upward across the board in the last 90 days, with 37 upward revisions for fiscal 2027. Next earnings report is May 20th. Now, the risks. First, customer concentration. NVIDIA's revenue is dominated by a handful of hyperscalers. Microsoft, Amazon, and Google together likely account for the majority of data center sales. If any of them slows spending or shifts to custom chips, the impact would be massive. Google already uses its own TPU chips for much of its AI work. Amazon is building Trainium. This is not theoretical competition. It is already happening. Second, the valuation puzzle. NVIDIA stock is flat since October, despite revenue growing 73% and earnings growing 82%. The market is telling you something. Either investors believe the current growth rate is unsustainable, or they are worried that AI spending returns are not materializing fast enough for the companies buying these chips. When a stock does not move on spectacular results, pay attention to why. Third, export controls and geopolitics. Every few months, Washington tightens the rules on what chips can be sold to China. Congress is pushing for even stricter limits. NVIDIA has been designing export-compliant chips, but each restriction narrows their addressable market. The worst-case scenario is a complete shutdown of China sales, which would remove tens of billions in potential revenue. Now for our POW analysis. POW stands for poverty or wealth, and it is our framework for examining a stock across 6 criteria. This is an analysis, not a recommendation. We looked at the data across growth, financial strength, competitive advantage, valuation, management, and risk. Here is what we found. Growth scores 18 out of 20. Revenue growing 73%, with analyst estimates revised upward across every time horizon. The addressable market is expanding into inference, agentic AI, and autonomous vehicles. Financial strength also scores 18. $97 billion in free cash flow. Return on invested capital of 150% crushes the cost of capital. Net cash on the balance sheet. Competitive advantage scores 19 out of 20, the highest moat score we have ever given. CUDA creates lock-in with no parallel in hardware. 90% market share. The moat is wide and widening. Valuation scores 14. Forward multiple of 22 times is reasonable for the growth rate, and there is a 23% discount to Morningstar fair value, but the stock has stalled, suggesting the market has partially priced in the growth. Management scores 9 out of 10. Jensen Huang has led this company for 33 years, beat guidance every quarter for 2 years straight, $34 billion in buybacks. Risk scores 6 out of 10. Customer concentration is the biggest concern. Export controls create unpredictable impact. Custom chip competition is early but growing, and the stock's inability to rise on record results tells you the market demands flawless execution. Total POW score, 84 out of 100. POW strong. The biggest strength is the competitive moat. CUDA plus 90% market share plus software lock-in creates one of the strongest positions in technology today. The biggest concern is the combination of customer concentration and the stock's inability to respond to record results, which suggests the market is already pricing in near-perfect execution with little room for disappointment. NVIDIA is not just riding the AI wave, it built the wave. It created CUDA before anyone understood why it mattered. It bet on data center compute years before generative AI existed. That foresight now produces $216 billion in annual revenue, with margins that look like a software company. The question is whether customers find alternatives. Every bull case depends on continued dominance. Every bear case depends on disruption. Next week, we analyze the most polarizing company in the world, Tesla, the stock Wall Street cannot stop arguing about, with a POW score that might surprise you. This video is for informational and educational purposes only. It is not investment advice. Always do your own research and consult a qualified financial advisor.